Okay, great. Welcome everyone to this American IRA presentation titled Adventures in Real Estate Volume 1. This is Sean McKay with American IRA, and first of all, I certainly appreciate everyone taking time out of their busy lives to spend a little time with us. And certainly, as the name indicates, today we're going to be focusing really on the real estate asset class as it pertains to self-directed retirement accounts. Certainly, as the title indicates, this will be a multi-series on real estate acquisition strategies, different deals that we see our clients doing currently. And so today we really are going to focus on the fundamentals of the self-directed concept as it relates to real estate and some acquisition strategies as it pertains to your retirement account purchasing real estate. So before we get too deep into that, we want to first make sure that if you're relatively new to the self-directed concept, you understand a few basic points. And the first one is when we're talking about a self-directed retirement account, there's a few things we should be aware of. And the first one is that, as the name indicates, this is a retirement account that is going to be directed by the account holder. So this is not a situation where at American IRA we are advisors that are bringing specific products to you as suggestions, as things that you might want to purchase inside of your retirement account. You as the account holder are going to be responsible for identifying the opportunities that make sense for your portfolio. Now certainly you may be leaning on the advice of attorneys, CPAs, financial advisors, as it pertains to real estate, perhaps real estate investors in your community, realtors, appraisers, whomever it may be. But at American IRA, our job is not to advise you, as it were, as to specific opportunities, whether that's a good or a bad idea for your portfolio. The second component is when we're talking about a truly self-directed retirement account, we're going to be talking typically about what we consider non-traditional or alternative assets. And so what we mean by that are assets such as real estate, mortgages, or deeds of trust, depending upon the state that you live in. So essentially being the bank for, for perhaps another investor. Investing in privately held companies, private placements, private offerings. And then there's also physical metals as well, such as gold and silver, precious metals that you can purchase inside of your retirement account. And we'll certainly delve into that a bit further, especially as it pertains to the real estate today. So at American IRA, we are considered the third-party administrator for your retirement account. And so really what that means is that we do the record keeping for the assets held in your account with us at American IRA, as well as the reporting to the IRS for what has transpired, the inflow and outflow of monies each year, as well as receiving the valuations each year from you as the client as to the current value of the assets in your self-directed account with us. Now, American IRA is a small boutique provider of this service. We're never going to be the size of a Bank of America, for example. We currently have over $300 million in assets under administration. We've been in business for 10 years, so we've been really fortunate to grow, frankly, pretty organically, word of mouth, and working with different investment organizations and communities. So our goal at American IRA is not to build the largest financial services firm in the world. We're just simply going to try and provide a high level of customer service and hopefully do a fair job of educating you on the opportunities as it pertains to your retirement account. So as I said, we are not financial advisors. We're simply the third-party administrators. The cash is FDIC insured with us, as it would be with any other financial institution. So the retirement account itself, it's important to note, is in its exact same form with us as it would be with other institutions. So The rules and regulations as it pertains to your IRA and 401k, you have the same contribution limits each year. You have the same ability to take distributions from your retirement accounts in your retirement years. So the retirement account itself, the components that comprise that retirement account are in its exact same form with us at American IRA. Now, I do want to take a moment just to make you aware, if you're listening live to this presentation today, we do actually have a questions box. I can't, to be honest with you, tell you that I'm going to be able to check that as we're going through the presentation, but please type those questions in, and certainly at the end, I'd love to delve into those questions. Perhaps something I said maybe was a bit confusing. Certainly if you have that question, more than likely others do as well, so you'll be helping all of us out if you're willing to type that question in. So as we look at real estate, certainly if you're currently investing in real estate, you're going to have your own reasons for choosing that sort of an investment. And for me, I'm a pretty simple guy, quite frankly. If you look at my bio, you would think that I would be able to understand more advanced concepts perhaps with an economics degree. My father's been a financial advisor for longer than I've been alive. I've been very fortunate to be around really intelligent people, but as it comes to stocks and mutual funds and things of that nature, unfortunately, I have a propensity to buy high and sell low. I don't do well with it. It's just outside of my area of competency, if you will. I look at real estate as a terrific option for a lot of us for a variety of reasons. Certainly just starting with the very basic concept that if you look at our society as a whole, statistically, the way that the majority of people have created their wealth has been through real estate. So I'm certainly a big fan of following smart people and trying to copy and frankly emulate what they do, especially if it seems like something that's within my area of knowledge, competency, something that I might be able to do fairly well. It's a life necessity. I look at a lot of different stocks out there and I say, I'm sure there's tremendous opportunity to make money in those stocks, but it's uncomfortable for me when I look at certain businesses and I think, they're very profitable, but will they be profitable in years to come? Is it something that the public needs to have in order for us to function? And I think of real estate certainly as kind of fitting that bill, where we're all going to need some place to live. Either we're going to purchase a property or we're going to be renting a property from somebody. So it's kind of one of those basic needs in our life. And certainly I think for a lot of us, we understand real estate much more than we understand a lot of other investment opportunities. I can't tell you how many conversations I have with people where they purchase 100 shares of you name a stock because they heard their neighbor has done it, and they're getting the good old hot tip from somebody, and maybe it works out well, but maybe it's a total catastrophe. And boy, I hope the person that you got that information from is exceedingly savvy and doing well on a consistent basis with these tips that they're giving out. I just think that most people put money into the stock market, but they don't actually understand the stock market. They don't take the time to read annual reports. They're not doing everything that they could do to become knowledgeable about that investment. As I said, I have a lot of respect for that industry. My dad's an advisor, and I think it's a great way, certainly, to diversify your portfolio, but I also think that real estate has a lot of opportunities for us as well. So as I mentioned, the self-directed account that you have with us at American IRA is in its exact same form. So if you have a traditional IRA with Bank of America, you're going to have a traditional IRA with us at American IRA. And it does not need to be an all or nothing proposition. It is not a situation where if you have $70,000 account with Wells Fargo, you're going to need to move the entire $70,000 to us, or you're not going to be able to do anything at all. If you choose to move $40,000, terrific. If it's $10,000, that's great as well. As I said, this is just another avenue for us to diversify our portfolio. And certainly one thing I also want to mention is that as we're talking about these real estate opportunities and ways that you can structure your deals, it's important to note that all of these retirement accounts can in fact purchase real estate. So whether it's the Roth, the traditional, the 401k, SEP, Simple, all of these accounts can in fact acquire real estate. You don't need to have a special type of account or designation inside your account. If you're opening the account with us, it is going to be eligible to purchase real estate. So as we look at the investment options, this is by no stretch of the imagination a complete list, but certainly some of the more popular investments that our clients are currently making in 2014. And so we start with the physical real estate itself. Everything from raw land to condos, townhouses, single-family houses, all the way up to commercial buildings can in fact be acquired inside of your retirement account. So just as your retirement account can own 100 shares of Exxon stock, your retirement account can own 123 Apple Street, which is a single-family home. So that's the physical real estate component. Essentially any type of real estate your IRA 401k can acquire. But it can also make a loan, and perhaps that loan is going to be secured by the real estate as well. So most of us understand the concept that if we're going to purchase a home for our family to live in, typically we're going to need to get a loan in order to make that purchase. And so we'll go to Fifth Third Bank, for example, and we're going to get a loan from that institution, and they're going to give us the money secured by the property in the form of a lien. Essentially, they're going to be what we consider holding the paper. So there's essentially two conclusions when we're borrowing money from the bank. Either we're going to make our payments as agreed upon on a monthly basis, typically, or we're not going to be able to continue to make that obligation, and we are unfortunately not going to be living in that house, depending upon the state, within a few months or maybe a year or so, depending upon the backup with the foreclosures. But when you make a loan inside of your retirement account, typically you're going to be making that loan secured by some sort of collateral, whether it's a piece of real estate or some other collateral that you think is worth certainly in excess of what you're actually lending out. And in future volumes, if you will, of this series, we're going to delve really deeply into the lending component. Precious metals, as I mentioned, gold and silver, investments into LLCs or C Corps. Essentially investing into an entity can also be done with a retirement account. And there's a lot of different ways that can be structured. Tax liens and tax deeds is also kind of in that real estate arena, if you will. So if you're familiar with tax certificate sales, essentially what happens there is an individual that let's say that an individual lives at 123 Apple Street, and unfortunately for whatever reason they have not been able to pay their property taxes for the year. At some point in time, depending upon the county and the state regulations, the county is then going to sell the lien on the property for the unpaid property taxes. And investors will come in and they will purchase that tax certificate, and that tax certificate will have some sort of a specified rate of return associated with it. So an example would be, I'm originally from Florida. In Florida, the tax certificate sales, there's a 18% rate of return that you can get for a year of taxes that are unpaid. The 18% accrues until either the homeowner pays the back taxes plus the 18% owed, or after a few years, if the taxes continue to be unpaid, you actually have the opportunity to go through a process and actually end up acquiring that property, just simply for the unpaid taxes and some legal fees and what have you. But it's an interesting strategy, certainly one that we see that's growing in popularity, and we'll certainly be touching on that once again in further volumes of this series. And privately held companies, I think that this is a nice alternative that we're starting to see more and more of, where individuals like the idea of having a partial ownership in some operating business, but maybe the idea of a company that's listed on a stock exchange, say the New York Stock Exchange. It's kind of an intimidating concept to them. It's too big. They don't really understand some of the nuances of those businesses, and so they want to maybe invest in a company that's maybe in their own community. Maybe someone is creating a new business, or maybe they need an infusion of capital into an existing business. Your retirement account can actually get involved via being an equity partner, or maybe holding debt for that property as well, or excuse me, for that business as well. So as it pertains to the real estate component, in a nutshell, the way that I like to describe it to people is if you're currently making real estate investments, let's say personally or through an LLC, for example, if you're making an investment strictly for investment purposes, that you're purchasing that real estate, chances are you're going to actually be able to do those same deals inside of your retirement account as well. So as you look at this list, these are primarily the strategies that our clients are using. So rental properties, I'll do a pretty extensive case study in this webinar today on rental properties and how that flows inside of the retirement account. Fix and flip, where a account holder identifies an opportunity. Let's say it's a distressed property and it needs a bunch of work. The retirement account can purchase that property, pay the appropriate contractors and handyman men, and they can actually get that property up into great retail condition and sell that property to another investor or homeowner, whatever the case may be. Also, wholesaling can be done inside of your retirement account as well. So for those of you that are in the real estate investment community, you're probably familiar with this concept where either an individual, or in this case a retirement account, identifies once again an opportunity that's priced below the market value. Let's say that there's a property that they can get under contract for $50,000. And they know that that property is worth $80,000 or $90,000, but they did a great job of marketing and finding that opportunity. And so they have that property under contract for $50,000, and let's say they know another investor in town that likes those types of houses in that type of neighborhood, and that investor is willing to pay them $55,000 for that deal. Then essentially that retirement account is going to be able to sell that contract and essentially create that spread of $5,000. They have it under contract for $50,000 and they're selling it for $55,000. They can create that $5,000 spread just by having knowledge of a particular neighborhood, for example. So that's a great strategy that we see a good bit of. The retirement account also has the ability to do an option on a property. And so as we're defining an option, what that means is that the retirement account has the right but not the obligation to purchase a property at a certain price for a certain period of time. So an example would be very similar to a wholesale concept. With an option, let's say that Steve's IRA identifies an opportunity to get an option on 123 Apple Street for $80,000. Now, the IRA may end up acquiring this property, or it may end up finding another investor to sell the property to. But they have the property under contract for, I believe I said it was $80,000, and they think that that property is worth $120,000. And so they put, say, $1,000 of option consideration, and they have negotiated a 6-month period of time in which they have the right but not the obligation to purchase that property for $80,000. So let's look at the two outcomes from this deal. The first one is that let's say Steve did a poor job of running his analysis on the property, and as it turns out the property is worth $70,000 and not $120,000. There's no buyers out there and it's not a good deal. What Steve's IRA would lose if he decides not to purchase this property is $1,000 of option consideration that he's put into the deal. However, as it turns out, the property is in fact worth $120,000, and Steve wants to use $80,000 in his retirement account or use some of the other strategies we'll talk about today to actually acquire the property. Then Steve has 6 months to get things in order so that the IRA can actually take that deal down. Or he has 6 months to identify another investor who's maybe willing to pay $90,000, and so he's creating a $10,000 spread for that deal. There's also the opportunity for retirement accounts to joint venture on a deal with individuals or companies or perhaps other retirement accounts, and we'll touch on that today as well, where the retirement account is not going to be the sole owner of the property, but it's going to be one of multiple owners. And also private lending, as we spoke about with being the lender on a deal. Sometimes it's called hard money lending. Depending upon how things are structured, there's a lot of ways that your IRA can be a lender for other real estate investors and sometimes get a really terrific rate of return. As I said, that'll also be touched on in future volumes. So as we look at the scope of the deals that are possible inside the retirement account, really the first thing we have to start with is what we cannot purchase inside of our IRAs and 401ks, and these are what we call the prohibited assets, and this is IRS code 4975. And the reason why I mention the specific IRS code is that if you have not yet created a self-directed retirement account, more than likely at some point, if you elect to move some portion of your retirement account and self-direct it, the institution that currently holds your retirement account, when they catch wind that you're doing something like this, they're going to talk you out of it. This is dangerous. This is not what you want to do with your IRA or 401k. They're going to say it's illegal. It's, you know, whatever the case may be. This is a great opportunity to just simply have them perhaps become a bit more savvy on what retirement accounts can in fact do. Because the way the IRS code is written is it does not say you can purchase stocks, you can purchase a rental property, you can purchase bonds. It simply tells us what we cannot acquire inside of our retirement account. And that is a short and arguably strange list, and it's essentially collectibles and life insurance policies. So collectibles that you might hear about would be something like antiques or some sort of artwork. Maybe it's a fine wine. Those would be collectibles that would not be something that you could purchase inside of your retirement account. Also something like a vehicle, some sort of a old vintage car that's considered a quote-unquote collectible. Unfortunately, your retirement account could not acquire that asset as well. There's also a list of individuals, what we call disqualified persons. And these are people that are going to need to have a very specific relationship as it pertains to your retirement account and what your retirement account is purchasing or selling, or in the case of real estate, leasing. So with disqualified persons, we start with the account holder, that is you. Then there's your spouse, entities that you own or control, such as LLCs or companies, and direct lineal family members, such as grandparents, parents, children, grandchildren, and their spouses. These are individuals that would not be able to purchase a property from your retirement account, sell a property to your retirement account, rent the property out, even if it's fair market rent, cannot do it, or provide any services. And in the next slide, we'll touch on what services entails. But these are individuals that are going to need to be very careful of how they're involved with your retirement account and the assets owned by your retirement account. So as we look at real estate, let's start with the acquisition of the property. Perhaps you're going to use a realtor on the transaction. That realtor cannot be one of those disqualified persons. As you're making the acquisition, you're going to be, in most states, closing with a closing attorney or some sort of a escrow company. Unfortunately, the agent nor the actual company itself could be run by a disqualified person. As you're getting the property, in good working order. Let's say that it's a rental property and you're going to need to put $10,000, paint, carpet, appliances, whatever the case may be. Unfortunately, the disqualified persons cannot provide the sweat equity to the project. So that's, painting the property, putting a new roof on, doing HVAC work. The retirement account is going to need to hire out appropriate third-party resources to do that sort of work. Now, property management is something that, quite frankly, in our industry, you're going to get differing perspectives on. Some companies will say, well, as long as you're not paying yourself to be the property manager, everything can kind of be run through the IRA company and you don't need to officially be seen as being the property manager for the asset. If you currently own rental properties, and I'm speaking with experience in this situation, if you are a property manager, I manage my own properties for my personal portfolio, my personal LLC. If you have rental properties, you understand it's not a matter of if, but when you have a tenant that is unfortunately not going to follow the rules, things are going to happen in their life and they're not going to be able to pay rent, or for whatever reason, you are going to need to get that tenant evicted from the property. In the state of North Carolina, the start of that process, after you've given them the appropriate notice that they're in default or they're not following the rules, is you need to start to file paperwork with the county. And in North Carolina, that starts with a summary ejectment. Now, the account holder and all of the other disqualified persons cannot fill out that paperwork. They need to have a third party that is acting as an agent doing those appropriate elements of paperwork. So if we look at this rental project when we're acquiring the property, and we understand law of averages, if we own this property long enough, there's unfortunately going to be some situations where we need to have an agent acting on behalf of the property in some fashion. Doesn't necessarily need to be a full-blown property management firm. It could just simply be a third party, maybe a friend, a fellow investor, a non-lineal family member. They can act as an agent representing the property. It really makes sense on the front end, if your retirement account owns this property, to not have any of those disqualified persons in any way handling the property management duties. So in terms of the transaction process, I just want to briefly highlight that as it pertains to a self-directed investment, it is the same process that we're used to if we're purchasing a mutual fund, for example. Before we can do anything, we have to first establish and fund our account. We're then going to identify the opportunity for that portfolio, whether it's a mutual fund, a stock, a bond, or it's a rental property, it's making a hard money loan. At that point in time, we're then going to work with the financial institution that's administering our retirement account so that the end result is the retirement account owns either the mutual fund or the condo that the retirement account is going to rent out. So we're now going to go into the actual case studies, and so this is a situation where the retirement account, my screen went blank for a second there, where the retirement account is going to be the sole owner of the property, and this is going to be essentially a buy and hold. This is going to be a rental property owned by the retirement account. So the numbers, very simple, and frankly, the numbers are just to illustrate that the money is flowing in and out of the retirement account. The IRA is going to purchase the property for $50,000, put 10 into it. There's going to be holding costs such as HOAs, proration of taxes and insurances, whatever the case may be. Total cost of about $60,000, $61,500 specifically that the retirement account has put into owning this property. So the mechanics are, in the initial acquisition, the very beginning, the offer to purchase will need to be signed in the name of the retirement account as the purchaser of this asset. If you are just doing your first self-directed deal, I always encourage clients to give our Asheville office a call and simply say, I'm buying 123 Apple Street, how do I need to do this? And we'll send you a set of written instructions so that you understand how the offer to purchase will need to be filled out and the flow of the process so that the retirement account can in fact actually own this property. So keep in mind, the IRA is not going to be taking a distribution of funds and then you're somehow buying the property and then somehow in the future the retirement account will gain ownership of this asset. From the very beginning of the process, the IRA is making the acquisition. Then after the time of purchase, you're going to hire the appropriate contractors, subs, whomever it may be, to provide the actual work, get the materials, do the labor so that the property is, in this case, in rentable condition. And then ultimately, because the retirement account owns this asset, all of the income will also flow back to the IRA. So if you compare this to the stock world, for example, let's say that you have a stock that's paying a dividend of 2.5%. And so let's say it was a $100,000 investment. And so for the year, you're going to make $2,500 in cash flow, if you will, from that stock. The IRA owns the stock, so the IRA gets all of the dividends that are paid out and either reinvested into the company that you've invested in or placed elsewhere. Same thing is true here. The IRA owns the rental property, so the IRA gets all the income associated with the rental property. If you're new to rental properties, I just threw up numbers. Frankly, this case study is a deal that I own in Charlotte, North Carolina, and it's just kind of a very vanilla deal. I don't pretend to be the world's most savvy real estate investor, but this is how you can analyze the cash flow. So I'm into the property, as I said, for $61,500. The gross rent each month is $900. I use a 10% vacancy rate, so essentially that means that I project that 10% of the year the property is not rented. So that gives me an adjusted gross income of $810. Now, some expenses are expenses that are paid once a month, some are paid once a year, and some crop up every few years. But just to kind of give you a flavor of how it looks, if you break down the annual property tax bill to a monthly bill on a property that'd run me in this price point somewhere around $85 a month, insurance is about $40, and the management, very rough estimate for a management fee is about 10%, so that would be 10% of the income when the property is actually rented. Keep in mind, not the gross rent, but when it's actually rented, they get 10% of that, so that's $81. And then you also always want to be putting aside money for reserves. Certainly with real estate, we understand things break. There's materials that need to be replaced over time, whether it's paint and carpet or new roofs, new HVAC units. So in my mind, putting aside $100 a month in cash flow is a rational decision. So the expenses total just over $300. So your net operating income, your true net cash flow, if your retirement account owns this asset, is going to be just over $500. So if you annualize the $500, you're at just over $6,000 a year in terms of the cash flow. And so if you're into a property for $61,500 and your income is $6,048, then you got a 9.8 or somewhere in the 9 or 10% ballpark of a rate of return, a return on your investment dollar. So if you pay cash, you do not have any debt on this property, you're making somewhere around 9 or 10% each year in terms of your cash flow. So as I said, this is a deal that I think a lot of us can do. This isn't prolific, fancy, pie-in-the-sky type stuff. This is just nice, solid return that we're going to be able to compound every year. Now, one thing I do want to mention here is that when we do deals personally, we're used to the fact that there's a tax consequence associated with income derived from our investments. That is not the same situation when a retirement account owns a property. If a retirement account owns a free and clear piece of rental real estate, as we just examined, all of the profit flows back to the IRA. You're not paying Uncle Sam any portion of that net profit, all of the money is either going to be tax deferred if you have a pre-taxed account like a traditional IRA or a 401k, or it's tax-free if you have a Roth IRA or a Roth 401k. In either case, all of the money flows back to your retirement account. In your retirement years after 59 and a half, then that is a situation where if you have a pre-taxed account and you pull money out in the form of a distribution, you will have a tax consequence at that point in time. Conversely, if you have a post-tax account like a Roth IRA, then all of the money will come to you tax-free, assuming that you've had the account for at least 5 years and you are 59 and a half when you start to take those personal distributions. Now, another thing I want to highlight as it pertains to kind of the tax ramifications, if you will, is a lot of people, when we discuss the portion about you cannot provide the services, have a real issue with the fact that they have to hire out for all of the labor and materials to be run through third parties. They say that's more expensive, I like to do the work myself, and frankly, I can't really relate to that because I'm not the most handy real estate investor, so I find myself, whether a property is owned by me or by my retirement account, I need to get smart, savvy people that can get that work done for me. But the point is, a lot of people get caught up in the fact that they're having to pay some sort of a premium to have third parties do all of the work for a property. But if we look at a fix and flip, and we look at two different scenarios. The first scenario is an individual has a property in their LLC and they fix and flip a property, they purchase and sell the property within a 12-month period. They're going to have short-term capital gains and they're going to have a very significant tax consequence depending upon what their tax bracket is. They might be in the 30 or 40% tax bracket, meaning that if they make say $100 or let's say $50,000 on this fix and flip, then they might end up having to pay $15,000, $20,000, $25,000 of that profit to Uncle Sam for doing that deal. And that's rough. Now, if we compare that to the retirement account itself, doing that same deal where it's going to do a fix and flip and buy and sell that property within a 12-month period, the IRA, as I said, all the profits are tax deferred or tax free. So depending upon, or irregardless, I should say, of the type of retirement account, if you do that deal inside of the account, that the $50,000 profit flows completely back to the retirement account. Uncle Sam is not touching your profits. So just something for us to think about as we look at the analysis. This is a situation where you're going to have to pay other people to do it, but if you look at the money that you're saving in terms of your tax consequence, typically you're going to find that the net is that the retirement account is going to be a more profitable way to do a lot of real estate deals as it pertains, or if you're comparing that to doing deals outside of your retirement account. So then there's the idea of actually partnering the retirement account with another individual or another retirement account. And so the most basic example I can give is if it's a $100,000 property, and let's just keep it easy and let's say that it's a 50-50 split between a retirement account and another individual or another retirement account. That means that if you joint venture on this deal, all the profit and all the expenses in a 50-50 scenario would flow back 50-50. So let's say that there's two members of a real estate investment group and for whatever reason they want to partner on the deal. Maybe the retirement accounts are not large enough to do the deals themselves, or maybe they're looking to diversify and they want to be able to have partial ownership of a few properties as opposed to having all their eggs in one basket, if you will. So in that example, they're going to each typically bring 50%. If they're doing a 50-50 split, they'd each bring 50% of the money for the acquisition, for the rehab, and then conversely, any and all expenses would also flow back 50-50. All the profit is 50-50 as well. So if it's a rental property and the net is $500 a month, each account would get $250 for their ownership in this property. Now, it does not have to be a 50-50 split. It can be 80-20, it can be 70-30. It's whatever the two partners agree is kind of a rational way to split the ownership interest in this asset. So certainly whenever you're looking at creative ways to structure deals, we highly encourage you to speak with CPAs, attorneys, whomever you count on for technical, tax, and legal advice to see what is the best way to structure it. But conceptually, we just want to make you aware that the IRA can have a partial ownership in a piece of real estate. There's also the ability for the retirement account to borrow money. So the IRA can actually be leveraged in a deal. And so the basic gist is that the account holder identifies the property, good old 123 Apple Street, and it's a $100,000 property, but unfortunately the IRA only has $70,000 in it. So certainly they're not going to be able to do the first option of a cash purchase. And let's say that for whatever reason they don't want to partner with other individuals or other retirement accounts because they've heard a lot of partnerships go sour, and there's a lot of ways that you can ruin friendships by doing partnerships. So they just want to have the IRA as the sole owner of this property, and that's certainly a logical way to analyze that situation. And so the IRA is going to purchase the property, and it's going to pay any and all expenses as we've spoken about. Conversely, the income will initially flow back to the retirement account. If there's debt on the property, then certainly just as we're used to as individuals, the IRA would also have to make the mortgage payment to the lender on the deal. Now, if the IRA is going to be leveraged for a deal, it is going to need to have a very specific loan. That type of loan is called a non-recourse loan. And what that means is that the IRA is borrowing money from the institution or perhaps the individual, and that lender understands in case of the worst case scenario of the default or the foreclosure, the only thing that lender can do is simply take that property back. Whatever that collateral is, the condo, the townhouse, the commercial building, whatever it may be, that bank, that institution that lent the money is just simply going to foreclose, get the property back. It cannot sue the retirement account. It cannot sue the account holder. It is purely a collateral-based loan. Now, we want to understand that when we're making these sorts of arrangements for our retirement account, we need to be cognizant of a few things. The first is, quite frankly, non-recourse loans are much more challenging to get. It's not like the days where we can go and get a personal loan or a loan through our LLC and put a minimal amount down of 5, 10, or maybe 20%. An IRA, because it is a non-recourse loan and a lender understands that they want the IRA or whomever that borrower is to have as much skin in the game as possible, the IRA is typically going to need to put a pretty substantial down payment. It might be 30, it may even be 40 or 50% that the IRA is going to have to put as a down payment. On top of that, the institution, the lender, will want to see that the IRA also has reserves in case of a vacancy or maybe mismanaging the project, getting it so that it's in really good working order. The IRA is going to need to have a lot of available capital. However, as I said, the IRA is going to be the sole owner of the property. So the IRA is going to be paying all the expenses, and the income derived from the asset, as I said, initially flows back to the retirement account, and then some portion of that will be used to pay the mortgage payment. Now, we want to understand that there is an important concept here, that if an IRA is borrowing money, if at the end of the day it's deemed that there is a net profit associated with the ownership of that property, then there is the possibility that there is a tax consequence being created. And the rationale is that the IRA is using money from outside of the IRA to do a deal, so a portion of this project is going to be leveraged and subject to what we call UDFI, unrelated debt financed income. And so you're going to need to work with your CPA to identify what that potential tax ramification is for your retirement account. What portion, if any, of that property can be depreciated, what portion, if any, of the mortgage interest can be written off, whatever goodies your CPA advises you can be boiled down into that equation, and then ultimately there's going to be a net profit or a net loss. If there's a net profit, as I said, there's the potential for UDFI. So you want to be very careful when using leverage inside the retirement account, A, that you're not using too much leverage and putting your retirement account in a bad spot, and B, being aware that there is the potential for a tax consequence inside the retirement account if it's a net profit. So as I mentioned in that slide a bit ago, you want to make sure that first you get your account established. We do have application kits for different types of retirement accounts. If you're initially creating a new retirement account, you can just simply make a contribution to that retirement account using our deposit coupon. If you're moving over an existing IRA, then typically you'll want to use our transfer form, which is also in that application kit. And if you're moving over an old employer-sponsored plan, let's say it's an old 401k or a thrift savings plan or a 403b, typically you're going to roll that over, and that'll be rolled over into another pre-taxed account, a traditional IRA with us. And that's the movement of the monies. That's the second phase. And then, as I mentioned, the third phase is contacting the office so that your retirement account can walk through methodically the acquisition of the asset, whatever it may be. So I'm going to leave the information up here for a moment. I'm going to check and see if we have any questions. My email address is Sean, S-E-A-N, at AmericanIRA.com. Our Asheville headquarters number is 828-257-4949, and our website is AmericanIRA.com. Excuse me. And let's see if we have any questions out here. Okay. So it looks like we had an individual that was having a little bit of issues with the audio portion. When will part 2 of this series take place? Thanks for that question. Essentially at this point in time, what we're doing is each month, hopefully you get our monthly email blast. If not, you can sign up via our website. And each month we're going to roll out kind of a new element of our educational series. So next month we'll be coming out with Volume 2. As I mentioned, we'll probably be covering some elements such as the private lending, some strategies such as wholesaling, purchasing tax liens, whatever the case may be. There's a question, do you have to hold my funds? As it pertains to retirement accounts, there are options available for an IRA, where an IRA can become a member of a new entity, such as an LLC, and have what the industry calls checkbook control. And with that checkbook control, the funds are held at the financial institution of the account holder's liking, and so they'll have that checking account set up and have the ability to write checks on behalf of that IRA-owned LLC. That is such a, I don't want to say a complicated, but it's an involved process, and we have specific educational elements that we'll be discussing that really focus on the mechanics of that. It can be a great tool. It can also be something that you want to be very careful as to how you're using. So thanks for that question. There's also the element with the solo 401k. Once again, that's a specific type of retirement account. That's for an individual that is self-employed without full-time employees. And so in that scenario, there is an option with the solo 401k where you can be your own trustee, and we simply provide the 401k plan. However, just like with the IRA-owned LLC, the solo K can have a checking account set up with the institution of your choosing and have the capacity to write checks and to do deals on the spot. Okay, so there's a question about the timing as it pertains to the account being available for use. And so essentially the way it's structured is from the day that your account is established, there's a 7-day right of rescission where essentially your account is going to be frozen. You will not be able to make any acquisitions during that first 7 days. So really it's going to be, if everything goes well, the 8th day would be the first day eligible. What we find is typically the investor is going to be waiting some period of time, maybe it's a few weeks, for their current custodian to actually get those funds moved over to us, whether it's a transfer or a rollover. If you do have a time-sensitive deal, I would highly suggest that you have the funds wired to us as opposed to a check cut. With a check being cut and sent to us, without the front and back of the check, it can actually take up to 11 days for our custodial bank to verify those funds and essentially have those so that they can be turned around for a particular investment. So thank you for that question. That was a good one. There's a question about, will this be offered in the evening? I would be transferring funds from John Hancock. About how long would the funds take to transfer to you? So in terms of the, will this be offered in the evening, I presume that's in terms of our educational webinars. Certainly if there's a particular module that you'd like to view again, or you don't have the opportunity to view live when we have these webinars, you can certainly contact us and we can send you a recorded version of whatever that webinar may be that you're interested in. So thanks for that. I would be transferring funds from John. How long does it take to get the funds transferred? What we find is that certainly with a firm like John Hancock, they're a large institution, and it's really predicated on the particular processor that we end up working with. Certainly they do their best to get funds turned around and transferred out or rolled over to another institution, whatever the case may be. It's very difficult to say how long that processor will take. A very general average that we use for clients is somewhere between 2 to 4 weeks. However, if you as the client are willing to follow up with them as well as we do, that does tend to expedite the process. So thank you for that question. What is the best way to obtain training on tax liens? That's a great question. There are national speakers out there that do talk about tax lien investing. Personally, I have not had an experience with a particular speaker, so I would be ignorant on throwing a particular name or company out there. But certainly if you're on the web, you can find companies and certainly do your diligence as to whether they have a high satisfaction ratio, and there's all sorts of things like that on the internet these days. But to be honest with you, my personal experience, I had a friend or two that had done well with it, and they were gracious enough to share some information, and it's been just frankly some personal trial and error with that. So certainly good luck with that. I wish I had some particular resources, but that's a sect of the real estate educational world that's perhaps maybe a bit underserved currently. Can a traditional IRA be converted to a solo 401k? Yes, a traditional IRA can. As I said, assuming that the individual qualifies for a solo 401k, essentially all retirement accounts can in fact be converted to that solo K, except for the post-taxed account like a Roth IRA. That cannot be converted to a solo 401k. So thank you for that question. Any others out there? Okay, great. Well, great questions. Thank you so much for joining us today and taking the time to learn a bit about the real estate component. As I said, we'll have future volumes. Certainly, hopefully we hope to see you there for those, and give our processing team a call if you're a current client, you have any questions or need to work through the mechanics of how to make your first investment. We'd love to assist you with that. So thank you all, and have a terrific day.